As we approach the 2026 tax year, a striking reality emerges. A large share of rental property owners are still missing out on thousands of dollars in legal tax savings simply because they do not understand how depreciation truly works. This gap in knowledge has consequences. When depreciation is calculated or reported incorrectly, owners risk overstating taxable income, triggering avoidable tax exposure, and increasing the likelihood of IRS adjustments later, especially at the time of sale when recapture applies. Yet the opposite is also true. When used correctly, depreciation becomes one of the few IRS-approved tools that can consistently reduce annual tax liability while strengthening long-term cash flow. And that's why understanding it now, before the new tax cycle begins, matters more than ever. As we enter the 2026 tax year, one issue stands out for rental property owners. Many still misunderstand how depreciation should be calculated, reported, and integrated into their broader tax strategy. The core problem is simple but costly. Depreciation is not optional, and the IRS treats it as though you claimed it, even when you didn't. That means improper reporting or failing to claim the deduction at all can distort your property's basis, inflate taxable income, and create a larger than expected recapture bill when the property is sold. This problem affects a wide range of investors. Small landlords managing a single rental often rely on outdated assumptions about write-offs. Larger portfolio owners face more complex allocation challenges, especially when separating land value from structure value, and first-time investors influenced by online content frequently confuse depreciation rules with general expense deductions, leading to inaccurate filings on Schedule E. The consequences of misunderstanding depreciation go beyond paying more tax in the current year. Owners may lose legitimate deductions for decades, miscalculate cash flow, or trigger red flags that increase the likelihood of scrutiny. More importantly, failing to understand how basis adjustments work can create unexpected tax liabilities years later, precisely when owners expect to profit from a sale. What makes this issue particularly relevant heading into 2026 is the broader IRS emphasis on accurate reporting, consistency across years, and proper application of MACRS rules. With real estate transactions slowing in many markets, investors are relying more heavily on tax efficiency, and depreciation is one of the few tools still fully within their control. So the real question becomes, what must property owners understand about depreciation to use it correctly and avoid long-term mistakes? To understand how depreciation actually reduces a rental owner's tax burden, it's necessary to look at the core data points that define the system. First, the IRS classifies residential rental property under the Modified Accelerated Cost Recovery System, assigning it a recovery period of 27.5 years. This means the structure, not the land, is depreciated evenly over that time frame. Commercial property, by contrast, follows a longer schedule, but the principle remains the same. Value declines annually in predictable increments, and the tax code allows owners to deduct that decline. A second critical figure is the distinction between building value and land value. Land does not depreciate, and failing to separate these values is one of the most common errors. For example, an investor purchasing a property for $265,000 must subtract the land portion, say $70,000, to determine the correct depreciable basis. Only the remaining value becomes eligible for annual deductions. Using that basis, depreciation is calculated on a straight-line schedule. For a structure valued at roughly $195,000, the annual deduction typically falls near the mid-four-figure range, depending on the exact service date. The IRS also applies the mid-month convention, which treats the property as being placed into service halfway through the month, resulting in a partial deduction for the first year. Subsequent years receive the full annual amount until the final year, when the remaining basis is recovered. Another important figure concerns additional depreciable assets. Appliances, fixtures, and certain improvements may qualify for accelerated methods, including declining balance schedules, which produce larger deductions early in their lifespan, But residential buildings themselves must always use straight-line depreciation, regardless of the method applied to other assets within the rental activity. Depreciation also carries implications for the future. When a property is sold, the IRS imposes depreciation recapture, taxing the portion of gain attributed to prior deductions at rates up to 25%. An investor who has claimed, for example, $46,545 in depreciation on a property later sold at a gain will have that amount recaptured before any remaining appreciation is taxed at capital gains rates. This mechanism reinforces the importance of accurately tracking basis adjustments throughout ownership. Taken together, these numbers outline a structured system: a fixed recovery period, mandatory separation of land and building value, a consistent annual deduction, and a recapture requirement upon sale. Each figure shapes how investors report income, estimate cash flow, and plan long-term strategies. But numbers alone do not reveal the full story. Their true impact becomes clearer when viewed through the lens of investor behavior, tax planning, and the timing of market shifts. So, what do these figures really mean for rental owners heading into 2026? The data points surrounding depreciation paint a clear mechanical picture, but their implications for real estate investors are far more significant than the numbers alone suggest. The 27.5-year recovery period reveals one important truth. Depreciation is designed to mirror the reality that rental properties generate value over long horizons. By aligning deductions with the economic lifespan of the asset, the IRS provides owners a predictable way to offset income. Yet this predictability can become a disadvantage when investors misunderstand how the annual deduction interacts with basis, cash flow, and long-term planning. The requirement to separate land from building value is another example. At face value, this rule may seem like a technical detail, but it speaks to a deeper financial principle. Only assets that naturally deteriorate can be recovered through depreciation. Investors who fail to allocate land correctly not only risk inaccurate deductions, but also weaken their financial planning model. For instance, overstating land value reduces depreciation, which quietly inflates taxable income year after year. Overstating building value does the opposite and increases recapture at sale. In both cases, inaccurate allocations distort the property's economic profile. The use of the mid-month convention also carries broader implications. Because the IRS treats the property as being placed into service at the midpoint of a month, investors must consider the timing of acquisitions more strategically. A closing date that misses the mid-month threshold can reduce first-year deductions, while precise timing can improve the immediate tax benefit. This element demonstrates how depreciation is not merely an accounting formality, but a tool that interacts directly with acquisition planning and year-end tax positioning. Depreciation recapture adds yet another layer of strategic importance. Many new investors perceive depreciation as a free deduction. In reality, the IRS views it as a temporary benefit that must be reconciled when the property is sold. Recapture, taxed at rates up to 25%, can substantially reduce net proceeds if the investor has not planned for it. Yet recapture does not erase the value of depreciation. It simply requires that owners integrate holding period strategy, cash-out timelines, and wealth-building goals into their tax planning. For long-term investors, the time value advantage of annual deductions typically outweighs the eventual recapture. Behind these rules lies a broader trend. The IRS expects accuracy and consistency, not aggressive maneuvering. As rental activity increases nationwide and more individuals enter the investment market, the agency prioritizes correct basis reporting, proper allocation, and consistent year-to-year depreciation claims. Errors no longer remain isolated paperwork issues. They accumulate across years, leading to discrepancies that draw attention during audits or when properties transfer ownership. Several common misunderstandings contribute to these issues. First, many investors assume depreciation is optional, believing they can simply skip it to avoid recapture later. In reality, the IRS treats depreciation as if it were claimed, whether or not it appears on Schedule E. Second, some believe that improvements and repairs follow the same rules, but improvements may require capitalization and separate depreciation schedules, while repairs may be immediately deductible. Confusing the two can distort taxable income and trigger adjustments. Third, a widespread misconception is that depreciation always benefits the investor equally each year. In truth, its value depends on marginal tax brackets, portfolio size, and long-term exit plans. These deeper insights reveal that depreciation is not merely a calculation, but a framework that affects acquisition strategy, cash flow modeling, and asset disposition. Understanding its full impact positions investors to make informed decisions rather than reactive ones. And that raises the next question. How can investors apply these principles in practical, actionable ways as they prepare for 2026? Translating depreciation rules into practical action requires a structured approach, particularly for investors preparing their 2026 tax filings. The first step is to ensure that the depreciable basis of the property is calculated accurately. This means allocating the purchase price between land and building using a defensible method, often through county tax assessments, appraisals, or cost segregation guidance. Establishing this foundation correctly prevents years of distorted deductions and ensures that a future recapture aligns with actual numbers rather than assumptions. A second actionable step involves reviewing the timing of when a property is placed into service. Because the mid-month convention governs the first-year deduction, documenting the exact date the property became available for rent, not simply the closing date, is essential. Investors who rehabilitate properties before renting them out must determine when the property was truly ready for occupancy. This affects not only depreciation, but also the allocation of improvement costs between repairs, which may be deductible immediately, and capitalized improvements, which require depreciation schedules. Third, investors should maintain a separate ledger for depreciable assets within the rental activity. Appliances, HVAC systems, and structural upgrades often carry different recovery periods and may qualify for accelerated methods. Tracking these items individually allows investors to claim deductions accurately, replace assets strategically, and minimize errors that could draw scrutiny. It also ensures that when assets are disposed of or upgraded, their adjusted basis is correctly removed from the books. Understanding the benefits of these actions is equally important. Accurate depreciation can significantly reduce taxable rental income, improve net operating margins, and create more predictable year-end outcomes. For highly leveraged properties, the deduction often offsets a meaningful portion of interest and other expenses, enhancing cash flow even in softer rental markets. However, investors must avoid a common pitfall: misclassifying improvements and repairs. Treating substantial upgrades as repairs inflates current-year deductions but raises the risk of later IRS adjustments. Conversely, capitalizing short-lived items unnecessarily delays legitimate tax benefits. Another critical warning concerns depreciation omissions. Failing to claim allowable depreciation does not eliminate recapture. It only reduces current benefits while preserving future tax liabilities. For those looking to advance their tax strategy, two higher-level techniques can offer additional value. A cost segregation analysis, even at a simplified level, can accelerate deductions by identifying components of the property with shorter recovery periods. This approach is particularly useful for investors with multiple rentals or high-income brackets seeking near-term tax efficiency. Additionally, investors should consider how depreciation integrates into long-term planning, especially if they intend to execute a 1031 exchange, adjust holding periods, or transfer property ownership within an estate. These practical steps position investors to use depreciation not just as a compliance requirement, but as an integrated part of their financial strategy. But even with correct application, depreciation carries risks that investors often overlook, risks that become more visible as regulatory scrutiny increases. Even when depreciation is calculated correctly, several risks can undermine an investor's long-term tax position. The most significant is incorrect basis tracking, especially after capital improvements. When owners fail to update basis consistently, they may underclaim depreciation for years, yet still face full recapture at sale. This mismatch inflates the seller's taxable gain and eliminates the intended benefit of earlier deductions. Another major risk is misreporting service dates, which distorts first-year depreciation and signals irregularities that increase the likelihood of IRS review. Equally problematic are widespread misunderstandings about what depreciation actually covers. Many investors assume that anything worn out qualifies for a deduction. In reality, depreciation applies only to assets with determinable useful lives, meaning land, landscaping, and certain structural components do not qualify. Others believe they can avoid depreciation recapture by simply not claiming depreciation. This is incorrect. The IRS calculates recapture based on the allowable amount, not the amount actually claimed. Skipping depreciation merely reduces annual cash flow benefits while preserving full future liability. Another common misconception involves repairs versus improvements. The distinction is not subjective. Repairs restore the property to its original condition and may be deductible immediately. Improvements enhance the property's value or extend its useful life and must be depreciated. Misclassifying these items, either intentionally or by misunderstanding, creates inconsistencies that compound over time and expose investors to adjustments. There are also restrictions and exceptions investors tend to overlook. Properties predominantly used outside the United States, assets financed with certain tax-exempt instruments, and rentals held in specific entity structures may fall under alternative depreciation systems. Failure to apply the correct schedule produces long-term inaccuracies that become difficult to correct retroactively. To mitigate these risks, investors should maintain detailed documentation of improvements, establish clear service dates, and ensure consistency between reported basis and actual asset records. Consulting a tax professional becomes particularly important when disposing of property, reallocating basis, or restructuring ownership. Understanding these risks provides essential context for evaluating depreciation not only as a deduction, but as a long-term planning tool. And this brings us to the final question. How should investors interpret these rules as they prepare for the 2026 tax year? Depreciation is far more than a routine line on Schedule E. It is a structured system that shapes how rental income is taxed, how property basis evolves over time, and how gains are calculated at sale. Understanding its mechanics now, before entering the 2026 tax year, allows investors to align annual reporting with long-term financial planning rather than reacting to surprises years later. When applied correctly, depreciation strengthens cash flow, supports strategic reinvestment, and gives owners greater control over the timing of taxable events. The practical impact is clear. Investors who calculate basis accurately, separate land and building values properly, and maintain consistent records position themselves to reduce unnecessary tax exposure and preserve more of their rental income. Those who ignore or misapply the rules often discover the consequences only during an audit or at the moment of sale, when adjustments become costly and irreversible. So the key question becomes, how confident are you in the way your current properties are being depreciated? And which part of your strategy will you review first before filing for 2026? If you want a deeper analysis on 1031 exchanges, cost segregation, or long-term exit planning, feel free to suggest the next topic.